Nandini? Nandini?
I'm unmuted now, perhaps. Can you hear me now?
Yes, now we can hear you. Hello.
Lovely to see your voice. Lovely to see your face. Thank you for the invitation. How have you been?
Thank you so much for joining us.
It's my pleasure.
ايش يا وعد؟ ستيفن وين؟
Hi, Jalil. Stephen here.
Stephen. Hello, Stephen. How are you?
Hi, how are you?
I'm fine.
Good, good.
Good to have you.
Thank you so much. Yeah, we're glad to be here. We have 3 other colleagues as well lined up.
Very good. Very good. I think بدنا بول موجود بول. طب تحاول نتصل فيه. Mr. Stephen, are you ready to start? Your colleagues are already there?
Yes, I can see them on the right-hand side that they've joined. So thank you again, Jalil. This is a great...
Just before you start, I just want to have just a few words.
Of course.
And then we can proceed with this webinar. So I thank everybody for joining us in this webinar, and we apologize for the delay because of our board meeting, which took more than the time that we specified for. And we will start our webinar. In fact, I am very honored to have a very distinguished speakers with us. This webinar exclusively designed for our region, for the MENA region, and invited the relevant participants of the capital market. We have a capital market regulators, capital market authorities. We have stock exchanges, and also some leading institutions that really related to the capital market in the region. The seminar will be discussing the impact of COVID-19 on our capital markets, in particular in the MENA region. We have invited the international institutions, and we invited some international companies that they have worked closely during the pandemic. So in general, the panel will be 2 parts. The first part will discuss the macroeconomic impact of the pandemic and its effect on the economies worldwide and on the region. This part will be introduced by BlackRock. So Mr. Stephen Fisher from BlackRock will be introducing this session, and then we'll proceed with the other international institutions, the OECD, the IOSCO, and the World Federation of Exchanges, on what they think about the impact of the pandemic and how we are going to deal with it. Before giving the floor to Mr. Stephen, I just will give 1 minute as introductory to the panel from our distinguished speakers. Other than BlackRock, we have Nandini from the World Federation of Exchanges. Ms. Nandini, would you like to say something in 1 minute, just welcome introductory speech.
Thank you, Jalil, and what an honor and pleasure it is to be here representing market infrastructures, both exchange and CCP, around the world in this forum. The MENA region is an important region for us at the WFE. We have about 15 members and 3 affiliates from this region. It's one that is represented on our board, and indeed a lot of our work around systemic resilience and stability, and indeed on empowering growth in capital markets comes out of this region. So a pleasure to be here. I look forward to sharing perspectives and hearing from my other distinguished panelists. If I could just say, in this period that we have had, an unprecedented period, in general across the world and in the MENA region, market infrastructures have been extremely resilient. So that for us coming into month 4, if you like, of the crisis is one of the key aspects that we are thinking about, how we have been resilient, why we have been resilient, and how we can continue to show such robustness in terms of capital markets in general, in running and operating capital markets.
Yes. Fiona, OECD.
Thank you. Jalil, colleagues, it's a real pleasure to join you today. I have had the privilege of working with the region from the OECD for over four years now. But I have been working on corporate governance for more than 20 years. In terms of the COVID response, the OECD has been extremely active from the beginning, and we have been very closely monitoring the policy responses and the trends. And there is an OECD hub that has a lot of information that I think participants would be interested in. And now we're really looking more on analyzing the impact and also looking forward into the economic recovery. I look forward to the discussion. Thank you.
Thank you. I think Mr. Paul is still not connected with us. So I'll give the floor to Mr. Stephen Fisher.
Thank you very much, Jalil, and thank you to the Union of Arab Security Authorities. It is an honor to be invited to present at this very prestigious event today. I'm not going to take too much time saying anything other than to introduce our speakers. And the first speaker I'll introduce is a colleague based in New York, Amir Bassat, who is the head of Sovereign Emerging Markets Alpha in BlackRock Global Fixed Income. Unfortunately, Amir has to leave us very shortly, but I'd like to bring him in now just to give his view on the region, on the Middle East, and to offer a few thoughts. And then we'll turn it over to additional colleagues who will take us through both the global view and then client sentiment in the region. So Amir, please take it away.
Thank you very much, Stephen. It's an honor to be invited to this very prestigious webinar. Thank you very much for including me.
You're most welcome.
Thank you. I was going to spend no more than 5 minutes going over 3 topics: the medical situation in the region, try to quantify the economic shock that this situation is presenting, and maybe a few words on the policy response and its effectiveness. First of all, the medical situation. This is obviously changing by the day. As of now, I would assess, or I would judge that the situation is stabilizing in the region, but at a concerning level. Let me be more precise. The case count in most of the countries, actually all the Middle East countries, is still rising when you measure it over multiple days, the case count of the virus. But the good news is that it's no longer rising at an exponential pace. So the positive number of cases a day is stabilizing at this stage, but it's no longer going at the second derivative has turned to 0, in other words. So this is good news in that so long as the recovery rate is equal to the new infections, then the total number of cases, active cases, seem to have stabilized in the region. But this is still concerning because the number of cases are still rising. And to be technical about it, the notion of R0 in the region is still above 1. So we're stabilizing, but at a concerning level, and we're not out of the woods yet. The second point I was going to make within that same situation is that the region is opening up, right? We monitor a battery of high frequency indicators in terms of mobility to get a sense of whether the region is starting to come back to work again. And the good news is we are opening up. We've recovered on average around 20%. So we are 20% above the bottom, the trough being sometime in late March in the region. I would characterize that opening as moderate. In certain regions, particularly in Europe and in North Asia, that opening up is significantly higher, but at least the worst seems to be behind us. Still, I would be concerned because in other countries where the opening has been more aggressive, the case count has started to decline. That's not what we're seeing in the region. And hence, there's always a fear of a second wave. And you're already starting to see it in certain localized cases where things seem to be under control, and then they seem to be picking up again. In my country, I'm Lebanese, is one of those cases in point. So the medical situation, and that's the first part of my presentation, we're behind. The worst seems to be behind us. We seem to be stabilizing at a concerning level, but at the same time, we are opening, but there is still fears of a second wave, given that the situation is not completely under control. The output shock, which is the second part, is quite significant, right? And there are 4 shocks that the region is facing. The first of which is obviously the lockdown, right? The fact that in order to control the medical situation, most of the countries in the region have had to go through a significant lockdown, which means economic activity came to a complete cessation between March and May. And that is huge economic impact. I'll come back and I will summarize it in a second. The second shock that the region is facing is the fiscal. All right. Particularly here, it's as a result of a parallel but related, obviously, shock associated with lower oil prices, lower remittances, and lower tourism, depending on which country you're talking about. That has meant that the fiscal authorities have had to tighten the belt. And that is also a shock as well. There's also a third shock, and that's much less for the oil-producing countries. It's much more for the oil-importing countries, which is what I call the capital account shock. Most of the countries outside the GCC are still net importers of capital. And the tightening of financial conditions and the lack of dollars associated with the trade shock, remittances, tourism, oil, has meant that the cost of capital for most of these countries have actually risen. Conditions have tightened, and that will have an impact on the economy. So 3 shocks: the medical shock, the fiscal shock, but also the capital account shock. What does that mean? That means is that the region is going to go through a deep recession. So when we run the numbers, and that assumes reasonably, I think, that the recovery will start sometime in the second half of the year. So once you average a first half of the year where things truly collapsed, but then you put into the numbers some economic recovery in the second half of the year, you will still end up with, for 2020 as a whole, with a recession in the region, which we estimate at around 3.5 percentage points of GDP, which 3.4% to be more precise, which would make it one of the worst recessions in the region since the early 1980s, mid-1980s, when we faced the large, massive oil shock as well. So it's a significant shock. Our numbers is that sometime in 2021, the recovery will take hold. However, given a view, a still cautious view on oil and on the return of economic activity in the developed world and on the return of tourism and remittances and capital flows, we think the recovery in 2021 will be muted. And as a result, there will be an output gap, a significant output gap in the region well into 2021. So deep contraction in the first half of 2020, some recovery in the second half of 2020, muted recovery in 2021. You look at the 2 years as a whole, and there will be an output gap in the region, which is quite significant. Policy response, what are the policymakers doing? They're constrained, right? Some countries more than others. Let me give the big numbers and then get into some more details. The ability of the region to cut interest rates aggressively and engage in monetary expansion the way that the developed world is doing is limited. And it's limited for two reasons. One, because most of the countries in the region have fixed exchange rates. And your ability to ease monetary policy in the face of a fixed exchange rate is always complicated and always difficult. It's much easier to cut interest rates when you can let the currency weaken. You cannot do it in most of the EM countries. The second reason is that there's still a weak demand for money, a weak confidence in the region. And this is specifically for some of the poorer oil importing countries. And injecting monetary policy, injecting money supply in a world in which money demand is weak is always painful and always concerning because of the return of inflation and currency pressures. As a result of that, we think it will be a muted monetary expansion. We think monetary interest rates on average will be cut by 100 basis points, so 4 times 25, on average, obviously. We think there will be some monetary expansion for those countries who can afford it, but it will be only 3.6 percentage points of GDP on average. Compare that to around 25 percentage points of GDP in the developed world. Fiscal policy, the ability of the governments to react, is a little bit more comfortable, but not significant. On average, we think fiscal policy, fiscal stimulus will be 1.2 percentage points of GDP for the region as a whole. But within that, there will be a significant difference between the GCC, which we think, given their ability to counteract the shock through borrowing abroad, which they will do and use down the reserves, and the non-GCC that have no fiscal space whatsoever and very little ability to be stimulative. You put these two things together, and the average is just over 1.2%. So let me sort of summarize here. The medical shock seems to be behind us, but we're not out of the wood. The output shock, the growth shock to the region, is quite significant, and the recovery is likely to be muted. The policy response is there, but significantly slower and smaller than other countries that have more space. So let me stop there and turn it back to Stephen.
Many thanks, Amir. And I found that personally a very rich set of insights. So just conscious of time, I'm going to turn it over to Karim. Karim Chedid also calls the region home. He is an investment strategist in our exchange traded fund and index investment business. So Karim, will you just take us through 5 to 7 minutes around the global perspective to set Amir's comments in some broader context? Thank you.
Thank you, Stephen, for the introduction, and really happy to be on this webinar as well. Thank you for having me. So taking it to a bit of a more global perspective about the COVID shock, how it has impacted the economies globally and how different regions have been responding, I wanted to make a few comments here and leave you with some thoughts on asset allocation implications for the rest of the year, and also some thoughts on the role of ETFs, exchange traded funds, in the period of market volatility and how we've seen investors use them throughout the period of market volatility that we had just been through. So with the COVID shock, it's not surprising if I tell you that it's unprecedented. It has really no precedence in that it's very different to the global financial crisis. It's a recession by design. Governments across the world shut down economies to try and contain the virus. And now, as we come out of lockdown, it is really a question of how much of the damage that has happened from these lockdowns is permanent and how much of it is temporary. The more that we see that the damage is temporary, meaning that companies are still able to access cash flows comfortably, meaning that bankruptcy rates remain under check globally, especially here I'm talking about the US and Europe, the more likely it is that we can get back to the growth trend line that we had before this shock quicker. Now, in terms of comparing this shock to global financial crisis in 2008, we do think that we can get to this pre-shock growth trend line more quickly than we did post-2008. So we are looking at least in the United States, getting back to the pre-coronavirus shock growth trend line by end of 2021, meaning that we recovered to a point where we're back on track in terms of growth. This is in a year and a half, but it is a lot more quick than the recovery that we had post-global financial crisis, where the growth shortfall continued on for multiple years. And the main reason behind this difference, the way we see it, is that the global financial crisis shock was centered around the financial system and led to massive deleveraging and systemic risk, whereas today's crisis is a lot less systemic in nature. And even though the initial growth shock is of immense magnitude, we're seeing Q2 growth shrinking to the biggest shrinkages in many, many decades, to some measures in some regions going back to the 30s in terms of the amount of growth drop. But the propagation of this growth shock is much more limited, and so the recovery can be quicker. So this is a view of cautious optimism that I am sharing here. When we think about the asset class implications of this, it is important to think about the stimulus that we're seeing. So similar to Amir's comments about the stimulus in the MENA region, the stimulus globally has varied significantly between region and another. At first, the US was really taking the lead with a massive stimulus program, both from the Fed and also at the fiscal front, north of $1 trillion from the US government. What's really unique of this stimulus is that we have seen direct coordination between monetary and fiscal authorities. This is something that we did not see before in the GFC, in the 2008 crisis. This is something that is unique to this crisis. And this direct coordination between fiscal and monetary policy has huge ramifications on asset class implications, because it means that it could have ramifications on inflation expectations picking up. Even though in the immediate term we're seeing inflation surprise on the downside, it could very quickly lead to de-anchoring of inflation expectations, especially if there are no clear guidelines on how we exit this direct coordination between monetary and fiscal. But going back to the regional stimulus hands, Europe was initially behind the curve on stimulus, but has now started to really catch up. The ECB ramped up its pandemic purchase program significantly. And we saw a very, very important point, a milestone, if I may say, for the EU when Macron and Merkel, so the French and German leaders, agreed on a way forward for the European Recovery Fund. And the European Commission basically all but approved 750 billion euros for the European Recovery Fund, which will be a mix of grants and loans. But importantly, it is basically bringing major players within the European Union, Germany, France, European Commission, on the same page in terms of moving closer to debt mutualization in Europe, which means that we get closer and closer to fiscal integration and a single European bond that finances some of the fiscal demands that Europe has to deal with the coronavirus crisis. This means that on a tactical level, for the rest of 2020, a few thoughts to share with you. We are favoring European equities increasingly, because the risk premium attached to European equities is starting to shrink, and the risk of euro area breakup, which was always a source of risk premium in European assets, is also starting to shrink with this really important milestone with the Franco-German deal and closer view on fiscal integration, even if it still has many, many hurdles to cross. We're gradually more positive on cyclicals like the value factor and cyclical sectors that have been underperforming during the initial leg of the coronavirus shock. And we're less favored on EM, not a huge surprise given Amir's comments, less favored on EM across equities and debt, given that it's more limited in terms of fiscal room to react to the crisis. Although we do like China and we like Asia, which have been incredibly resilient in dealing with this crisis this year. And also, for example, on the fixed income side, China debt is still a very good source and stable source of yield in a yield-starved environment. But on a broad sense, our preference remains for credit over equities from a top-down perspective, because in an environment where we're in an earnings recession and broadly still in an economic recession, You want to be in credit, which is more directly supported by central bank purchases. So this is across investment grade and high yield, and also above equities in the capital structure. And then lastly, in duration, supported near term perhaps into the summer with some safe haven trades still at play and market volatility sources continuing, especially as we deal with more headlines around second wave infections and more headlines around how we're exiting lockdown and how smoothly we're exiting lockdown in different regions. And here we are seeing Europe managing it better than the US, by the way, so far. But duration may remain well bid into summer, but then over the longer term, we start to see duration coming under pressure, especially as inflation expectations start to shoot on the upside. So that sums up our views on the strategic and tactical asset allocation horizon in light of the coronavirus shock. Cautiously optimistic, favoring credit specifically more than equities, but still with some selective opportunities in equities like Europe on a tactical level. And then in duration, focusing more on duration management as we go into the longer term. I wanted to make a quick comment on ETFs before handing back to Stephen, especially as a sign of how investors have been using them this year throughout the volatility. At the height of the volatility in February and March, it was pretty clear that ETFs did serve an important role when investors were rebalancing holdings. So we actually saw significant trading pick up. One stat I wanted to share with you is that looking at fixed income European ETFs, for example, trading volumes in these instruments, it jumped 41% year on year in the first half of this year, which shows that they were strongly demanded as intraday liquidity sources across broad market exposures. We also saw that across the European landscape of ETFs, ETF trading was 43% of cash equity markets, which is double the level of trading that they usually formed in 2019. So significant jump in how ETFs were being used during this period of volatility. And then lastly, it was also interesting to see ETFs become price discovery tools during periods where other securities were not trading. So one example for this that is extremely popular to look at is some of the largest S&P 500 ETFs in Europe were the only trading tool that was open during periods when US equity futures were halting during the big drops in February, because out of US hours, the futures had halted. So the only instrument that European investors were able to use to see how prices were developing were the European domiciled S&P 500 ETFs. So just some food for thought to leave you with around this instrument and how investors were using it in the past few months, past unusual few months. I'll hand back to you, Stephen.
Thank you very much, Karim. And Jalil, I just wondered if it is possible to bring in an additional colleague, Mr. Ahmed Talawi, who heads up BlackRock's business in the Middle East and Africa region. I am conscious of time, so do please say if it's not possible to do right now. It was just to give a little bit of sentiment in terms of what we're seeing on the ground. And then I of course, want to go back to the main presentation, but if that's not possible, just let me know. Sorry, I can't hear you.
Stephen, I think I'm unmuted.
Okay, fantastic. Thank you, Ahmed.
Yeah, thank you very much. I'll be super brief. First of all, it's really a pleasure and honor to be part of this webinar. I just want to bring a little bit of local perspective.
Yes, go ahead, please.
Yeah, thank you very much. So yeah, I mean, I'm not going to repeat the interesting stuff that was raised by Karim and Ahmed, but yeah, it's definitely a recession by design. In my opinion, especially if I dare to draw a parallel with 2008, the stability of the financial system has not been compromised, in my opinion, which is something important. But more interestingly, this is something that I see on the ground in the Middle East, in North Africa, in the sense that markets are functioning. The institutions we engage with are responsive. We've been able to engage immediately after the crisis did start in the region. The level of engagement is very high. It doesn't mean that the situation is not serious, because in addition to the COVID-19, we have to deal with an immense pressure and volatility on oil prices. But I would say that from my point of view, the immediate response, especially the fiscal response that we've seen in countries in the region, has been strong, has been quick, and is probably the right one in terms of dealing with this dual shock, which is the COVID-19 and this oil shock. So I remain constructive, and I think it's important also to remind ourselves, just to be a bit more positive, that in spite of these challenges, this crisis will end. We know what it needs for this crisis to end and to see the activity resuming. And it's probably going to act as a catalyst. For example, in Europe, the socially responsible investments have definitely not been stopped or haven't slowed down because of that. I think, if anything, the capital allocation will be a lot more in that direction. In the region, we had a lot of good dynamics going on. We have institutions in the region, some wealth funds that are a lot more strategic in terms of how they want to deploy capital, attract capital to the region. We saw some very exciting developments in MSCI inclusions that involve a few countries in the region. So I think we need to keep in mind that it's going to be difficult, it's going to be tough. The response so far from the region is good. It's a global problem. And I think some of the encouraging trends that we've seen will resume as soon as this stabilizes. Thank you very much.
Thank you. Stephen, I have we'll take two questions because we will move to the second part of the panel. We have Lama want to speak, and Mr. Ahmed want to ask. Lama, are you with us? Lama?
Yes, hi. Can you hear me?
Yes.
Yes. My question, I think, will be related to the ETF. So what's the role of the ETF in this pandemic? They mention it's a trading, one of the trading tool in this pandemic.
Thank you. I have another question, Mr. Ahmed. Mr. Ahmed. Ahmed, are you with us? Mr. Ahmed? Okay, then we have the question of Lama. Mr.
Sure.
Stephen?
I'm more than happy to take that question. Thank you for asking it, Lama, and thank you, Jalil. So I think it's important to look at the market volatility of February and March as sort of case study for how ETFs behaved in terms of their resilience. I think there's a couple of things to share here. First, what Ahmed just said about comparisons to GFC and the lack of sort of financial stress in the system in this crisis is very important, because it means that market structures and financial markets continue to trade normally. However, it doesn't detract from the role of ETFs as a source of liquidity more than anything. So the way that the ETF works, the dynamics of an ETF, is that it has two levels of liquidity. The primary market, which is when trades are large enough that they lead to a creation of units in an ETF, and the secondary market where the ETF is changing hands without hitting the primary market creation or redemption.
Thank you, Ahmed. I have a question from His Excellency Dr. Abed Zaabi. Doctor, are you with us? Dr. Abed? Dr. Abed Zaabi?
Hello.
Yes, Dr. Abed, we are hearing you.
Yeah, I'm really glad, to listen to the, very prestigious speakers. They are co-born, the issues. We have learned a lot, from them today about the, effect of COVID-19 and how is, the significant relations on the financial markets, the country economies as a whole. But I would like to raise on questions here. If there is any elaborated information we could have from them in a way of after the COVID-19 being, stable status, where is to find, the financial market, in a way of recovery, in a way of, overcome the negative effect of the COVID-19s. Which products need to be, more concerned, and where is, the bottleneck recovery will be, beginning after the, after, let's say, transfer from the stable to the recovery status.
Yes, Mr. Stephen.
Thank you, and thank you, Dr. Abad, for the question. It's an excellent question. I think it varies obviously on a region by region basis, but what I've seen certainly in the Middle East and in other regions is the appetite to get back to an even footing as quickly as possible, and for governments to be more active than usual in their stimulus and in their involvement in capital markets generally as well. So I think what you could see is effectively, if you like, financial companies taking on a broader purpose. So in the case of BlackRock, we're here to serve our clients, of course. That is first and foremost our mission and objective. But in addition to that, there will be an expectation created by society, by government, that companies should do more, particularly regarding social projects. So when we think about an issue we've discussed before, ESG, for example, environmental, social, and governance issues, the S of that ESG part will become increasingly important. So I think, what will happen is you'll see institutions such as BlackRock and others become much more sort of aligned with this idea of creating this broader purpose. And I think, wherever there are investable opportunities, we will look at them very, very seriously, whether that's in the Middle East region or elsewhere. But it's difficult to be more specific than that, unfortunately, because I think the answer requires sort of quite a level of granularity per different country and per different region.
Thank you, Stephen.
Thank you. Thank you, Stephen.
In fact, if Stephen, we are okay with this section, I'll go to the second one, which is related to other speakers. If you allow me, would like Mr. Nandini to start the presentation. It's not the presentation, to intervention. And I know that the World Federation of Exchanges has a lot to say, especially recently, as I understood that you have a strong position and a strong stand regarding certain issues that might affect capital market. One example is the ban of short selling, for example. You have a straightforward position. So, Ms. Nandini, you have about 5 minutes. Please, you can elaborate on how the pandemic affecting the capital markets worldwide and in the region. Please.
Thank you. And thank you. We have, and thank you for that introduction, and indeed for hosting us here today. The World, as I said, the World Federation of Exchanges, we represent around 250 market infrastructures around the world, both CCP and exchange. And the MENA region has about 15 members for us, including and then plus about 3 affiliates. So we are quite broadly diversified across the region. Through the pandemic, and I say through the pandemic because it's clear to us as a global organization, the pandemic is not over. There are parts of the world in which are now the epicenter. We had a board meeting yesterday, and a significant number of the priorities from pandemic epicentered geographies were different from those of nations and markets that are coming out of lockdown and beginning to rebuild. So there is the resilience agenda and there is the rebuilding agenda. And both are equally important. It just depends on which part of the pandemic phase you are in. So we all started, I think, in March or the end of February, depending on when you define your terms. Of course, Asia and our 8 China members started earlier, much earlier. But we all began with the resilience phase. And if you were a market infrastructure, the markets have been resilient, exchanges and CCPs, market infrastructures have been incredibly robust in a remote working arrangement through the crisis. So that's something we have all taken comfort from, because we are at the heart of the ecosystem. So therefore, I would hope, for institutions such as BlackRock, where they come to a market, they come to an exchange seeking resilience, reliability, scalability, capacity, all those things that crisis clouds, it has been a good experience. For regulators as well, markets have been robust. They've been electronic, they've been remote, and they have performed, very well. This is not necessarily an accident. I think in the last decade, if you're a market infrastructure, you've been spending your time, all our members have spent their time investing heavily on resilience, on remote working, on contingency planning, all the kind of things that you hope you will never have to live again, you will never have to live through, but inevitably you do. So that has stood the industry in good stead. So a very, very resilient performance acknowledged by regulators and by stakeholders all over the world. What, however, has been one of the most kind of biggest issues, an issue of concern, and for us as an industry, we will take this as one of the lessons learned from the crisis, has been the tendency of some governments or markets to think about closing the exchange or shortening trading hours at a time of volatility and at a time of crisis. So we are very clear, I think, that to have resilience and to have a rebuild, to have that growth agenda that we were talking about a little bit in the first half of this session, your market, your exchange does need to be open. Your capital market stakeholders, your institutions do need to remain open through the crisis, because that is the only way you're going to have effective price formation. You're going to have stability of a kind where people know that if the market is open, the exchange is open, they can come and they can trade in and out. So I think the last thing you need during a crisis is really to be closing the exchange, because that in some ways exacerbates some of the anxiety and the angst that pandemics and crises trigger. So the keeping markets open piece is incredibly important. Where we have seen, and in the bulk of cases really, markets around the world, I think there have been 6 markets maybe which have either had to close or have had closed temporarily and reopened, or have had shorter trading hours. And some of them are in the MENA region. One of the key lessons learned already for all of us has been that typically it is not the regulator that is asking the market to close. It is the wider capital market. Sometimes it is the government, etc. And this is triggered by concern about volatility and investor sentiment to a certain degree. So I think all of us, regulator, buy side, exchange, market infrastructure, CCP, everyone in the ecosystem needs to think a little bit more. There needs to be, I think, almost like an educational piece that all of us do together with our stakeholders about keeping markets open. The second learning, I think, from the crisis has been very profoundly that different parts of the capital market ecosystem have different levels of resilience. So while market infrastructures have been incredibly robust, that has not always been the case consistently throughout the ecosystem. So I think that is again something that as a community, as a capital market, we should work on together in the MENA region and in other regions. There needs to be a move together to ensure that all parts of the capital market ecosystem are sufficiently robust and are running really able to operate at the same level. And I think we all understand, we talk about it in cyber, for example, but we all understand that all of us are only as functional or as strong as our weakest link. So I think the ecosystem needs a lot of thinking about. There needs to be some introspection. There needs to be some focus, I think, at looking at where the weaker parts of the ecosystem are, which have not perhaps been as robust as the market infrastructures. Now I'm going to conclude on a more optimistic note, which is about the rebuilding agenda. I think as an industry, we're very focused now. We're coming, as we begin to come out of lockdown in many parts of the world, very focused on that rebuilding the economy agenda. And for us, one of the most interesting things as an industry that we saw through the crisis was that IPOs didn't go away. Companies came to market and listed through the crisis. They didn't list as much as they did a year ago, but there were IPOs occurring through the crisis. And also, there's been record levels of capital raising, especially from companies that were already listed, which shows that, you know, this holy grail that we've all been working towards, which is in a crisis, capital markets are there for you, use them effectively to finance. That part is working, and we need to do more, obviously, to foster that, to ensure that there is an enabling ecosystem. And that is, of course, part of the role of the regulator, part of the role of the capital market infrastructure, part of the role of the OECD, to make sure that that enabling ecosystem exists. So with that, let me give it back to you, Jalil, and happy, of course, to continue this conversation.
Thank you so much. We are really enjoying what you said, and it's very, very comprehensive intervention, and it give a lot of take. Our next speaker will be Fiona from the OECD. Fiona.
Thank you, Jalil. It's really a pleasure. I really appreciate that you're giving me this opportunity excuse me, to participate in this discussion. I think your team, yeah, there's some slides there. I don't know why my video isn't working.
It's okay, you go ahead.
Oh, that's okay.
Maybe you can just press on the video.
No problem, no problem. That's wonderful.
Yes, go ahead.
Nandini was speaking about the ecosystem, and I think that's really appropriate because that's a nice sort of transition to what I am going to speak about, which is really looking more at the corporate governance side of things. I will sort of focus on a couple of points in terms of the structural issues that we think are extremely important now, and something we've already worked on quite a bit, which is the access to finance for companies and the transparency and disclosure. I think we can all agree that the MENA economies have made great strides to enhance their corporate governance structures over the past years. However, gaps remain. And under the umbrella of the MENA OECD Competitiveness Program, we have a working group on corporate governance, which Jalil and Dr. Obaid are involved in very intensively. Dr. Obaid is actually one of the co-chairs. I'm glad that he's joining this discussion. And the working group basically uses all of this sort of OECD approach, which is the international standards, like the G20 OECD principles of corporate governance and sort of best practices. And what we did is we looked over 3 years at the challenges in MENA in terms of corporate governance. And we came up with a report that was released last year that really focuses on the competitiveness of the region and growth. And this was not just something we did in our Paris office. This was really an interaction between all of the members of the working group in the region. So many thanks to Jalil and all the other regulators who contributed to this. So the report has a very rich sort of sharing of reform efforts in the region, and we hope it will be a useful tool. And what I wanted to do very briefly now is just focus on those couple of issues on access to finance and transparency and disclosure in terms of what we had developed earlier, and now to see, you know, what kind of challenges will we see now since the COVID pandemic in terms of achieving these commitments that countries made. So I'll start with very quickly access to finance. So some of the challenges, and I'm sure this is no surprise to this audience, is that the region has a very diverse capital markets, but the size of the market does not reflect the potential of the economy. The total capital raised, according to our figures, between 2008 and 2017 was $41 billion. Secondary equity offerings in the region have grown at a faster rate than IPOs. The share of growth company proceeds in non-financial companies was 35% in 2017 and compared to 18%. So there's been some changes there. And then we see overall low liquidity, limited sectoral diversification, and high market concentration ratios. So this is just a very quick snapshot. And so it'll be interesting to see from what I will describe then as the policy options that we agreed as priorities for the region, and how these may shift or be difficult to achieve or may need to change given the crisis. So the first one was developing strategies for capital market growth. And there we talked about investigating whether the preconditions for sound capital market development are in place, monitoring policy measures adopted by countries, preparing national action plans to monitor the results and revise regularly. We talked about the enhancing of the capacity of the key institutions, so particularly improving surveillance and enforcement capacity of securities regulators, deepening international cooperation, and also the independence and accountability of regulators. Improving capital market financing alternatives. I think you've already covered a lot of those, so I won't go into this. Also specialized markets for growth companies. It would be interesting to conduct a feasibility study to find a suitable model, and also monitor compliance and disclosure standards. And then in terms of developing the investor base, we found that was extremely important, and promoting a capital markets culture, sort of conducting, following through with the planned privatizations, encouraging the growth of institutional investors, improving the role of them in corporate governance, increasing the role of sovereign wealth funds, relaxing foreign ownership limits. And then finally, as was mentioned previously in terms of the ecosystem, so really making sure that we can enhance a sound financial ecosystem in terms of disclosure of potential conflicts of interest faced by service providers, evaluating alternative measures to increase analyst coverage, and establishing the right regulatory infrastructure to enable effective functioning of all service providers. So I realize this is a really tall order, but this is something that we already have and that we could look at as a framework to see further how the crisis will affect these objectives. Then very briefly, transparency and disclosure. Of course, don't need to repeat this to this audience, is an absolutely the DNA critical to any kind of recovery, capital market development in any country. In MENA, we focused on two particular areas that seem to be a challenge, which is the disclosure of beneficial ownership and control. We do see that major shareholders, directors, and listed companies are required to make disclosures, but there are still challenges in terms of the identification and disclosure of ultimate beneficial owners. And then disclosure of related party transactions. So there are requirements for this in MENA since 2014, but they vary with respect to the method and the timing in which related party transactions are disclosed. Also, thresholds for disclosure and shareholder approval are not adopted in many jurisdictions, and regulations vary in terms of the definition. So in addressing these challenges, of course, it's up to every country to define the mix of legislation and voluntary codes, and what works best in their context. But we do suggest considering mandatory regulation in cases where voluntary rules are not complied with. We also suggest considering improving disclosure related to beneficial ownership, related party transactions, and a few other areas. We suggest adopting flexible regulation in accordance with the needs of different types of companies in terms of size, sector, and complexity. We have done some work on this in terms of proportionality. So that could be a valuable source. Then we also recommended timely, consistent, and effective supervision and enforcement, again, like with the whole concept of making sure that we can increase companies' access to financing. This is absolutely critical to provide some security and safety for investors, to know that there is a risk-based approach for supervision, that there are clear channels for conveying information to authorities and adopting measures to protect whistleblowers. Shareholder engagement should be strengthened. This ties in with what I mentioned earlier. It's very important to promote active shareholder involvement by strengthening investor protection and improving public awareness, and also strengthen the function of investor relations departments in companies. I already mentioned, I won't go into details on having a proper disclosure of ownership. We have a number of suggestions on how to do that, and also the disclosure of related party transactions. And then finally, of course, the importance of comparability. I'm sure BlackRock and the WFE would agree, the importance of comparability and reliability of disclosed information using international standards. So this is just a very quick summary. The report is available online, and I would very much value any inputs that people may have on this webinar, including some of the speakers, to some of these points, and to see, how the crisis has shaken up these priorities. Thank you very much.
Thank you so much, Fiona. In fact, I have a question from Mohammed bin Muammar from Saudi Arabia Capital Market Authority. The question is, will the fund managers and investment bankers create new investment methods based on COVID-19 effect? This question is open for any distinguished panelist want to speak.
I think it's maybe better to give the floor to Stephen on this one. I have not been following this issue.
Okay, Stephen, are you still
yeah.
Stephen?
Sure.
I mean, just very quickly, what Stephen said earlier about ESG, I do know that a lot of colleagues are looking into this issue of ESG and ESG indexes.
Yes.
And I can see that there is more focus on this, but I think Stephen might have a better, more detailed.
Yes, Stephen.
Yeah.
Thank you. I think that's right, and actually it does follow quite nicely in terms of what I was saying earlier in terms of ESG and this broader expectation of finance and financial services for firms to play a full role in the recovery. The perception, the strongly held perception following the global financial crisis of 2008 was that the banks were bailed out and they didn't sort of assume their full responsibility from a societal perspective. I think going into this, because we had a little bit more lead time with COVID, there was a stronger sense that we're all in it together and that finance has to respond in the context of its societal purpose as well. So I just reiterate what I said before, and Fiona has just mentioned here as well. I think secondarily, what we have seen, and this picks up on what Karim has said in terms of how you actually implement your investment view as well, is that index funds and exchange traded funds have been used by investors for the first time to really implement views, because effectively they are very sort of cheap and easy ways of expressing a view on particular markets. So as sentiment shifts, perhaps currently away from the US, given the sort of second wave which is happening there, maybe towards Europe, which is generally seen as having sort of dealt with the sort of reopenings in a more consistent way, investors can quickly sort of take exposure through exchange traded funds. So I think the combination of this ESG stroke societal purpose with the tools you have available through index funds and ETFs gives investors the tools to actually be in control of their own allocation. I see those as being two main trends. I think more generally what is happening, just as is happening in the rest of the world, individuals are expressing greater preferences over their own investments and are looking for granularity and specific exposures, which express their own preferences. So many investors have gone into healthcare stocks, as you'd expect. Many investors have taken on companies which have behaved more responsibly during the crisis. So I think there are those products out there, and I think you'll see much more individual expression and investment going forward.
Maybe I can add one sort of higher level sort of response to this. The OECD recently came out with its economic outlook. And I think it's very clear that we are looking towards a recovery that will bring us to a different place than we were before. So I think, you know, just, you know, like Stephen said, there will be a lot of issues that, you know, both the finance, the investment, the companies will be looking at. So it'll be a much more sort of looking at green, looking at inclusive growth will be really important.
And just to add to that, I mean, we do
Yes,
a survey
Nadine.
every year of our members and look at their ESG efforts. And every exchange pretty much in the WFE universe is doing some form of ESG, either they're doing something around kind of disclosure, sometimes some of them are requiring reporting, all of them, many of them have kind of educational programs designed to aim, you know, designed to enhance interest, etc. So I think from a market infrastructure perspective, the trend has absolutely been towards more ESG. And what we're seeing, and this has been it's not new actually, for the last decade, it's been growing on exchange. If you look at the numbers. So this is the 6th survey we've done. And I think at this point, 90% of the respondents have at least one kind of ESG related measure on their exchange traded markets.
Thank you, Nandini. In fact, I have another question from Mishal. He's asking, do you think stock markets will constitute a new safe haven for hot money or liquidity in general, taking into consideration the double impact of COVID-19 and the fluctuating oil prices along with high uncertainty over the place?
Obviously, I'm not, I won't give investment advice, though Stephen should feel just trying to hit the bus. But what I can speak to is the fact that trading on an exchange is always going to be, you know, a safe place. So one of the trends that you see in every crisis, including this one, is a move from OTC markets onto exchange. And that's for good reason. That's because, you know, regulated markets are always, you know, more transparent. You know, you have fair and orderly markets, you have transparency, you have disclosure, you have accountability. So in general, you know, an exchange traded vehicle, whether that's a specific product, whether that's a stock, whether that's a derivative, whether that's any kind of security, on an exchange, you will absolutely, in fact, be safer than OTC, but also fundamentally you will long-term benefit from kind of good governance that Fiona was talking about, which is obviously a primary focus of securities listed.
This is the answer that we expect from you.
Well, I think it would be the answer I would expect from you too.
Exactly.
The greatest advertisement.
Exactly, but I just want to elaborate on this because every time you just have a piece of news, every day you have so many type of news coming up.
Yes.
For example, just in a few seconds, we got a news from the IMF that they mentioned that the impact and the worst impact is more and more than we expected. And the shrinking of the economy and the recession is also more and more than we expected. So from your perspective, what do you think regulators and exchanges have to react to these? This is just an example. This is one of the issues that you can imagine so many other pieces of news coming every day. So it's very important that at least from the regulatory perspective as a regulator or as a market oversight organization or service provider, there should be some advice that we should take this news in consideration.
So if I can maybe just talk a little bit then to some of the numbers, because I think that's always a great place to start then when we're thinking about a question like this, what are the numbers showing us? And if you look over the last, let's take a year-on-year change, and I've chosen May 2020 because it's a representative month of the crisis. And if you look at the capital raised through IPOs, and this is, in the MENA region, it's down 50%, right, on May last year. But if you look at, for example, capital raised by already listed companies on MENA markets in May, that's risen more, that's almost 10 times, that's up almost 10 times. So which is really an extraordinary number. And if you look at capital raised just in total, not just by listed companies, that's gone up, sixfold year on year between May 2020 and May 2019. So all the other things, I can talk to you about, like, what was the value traded in the exchange order book, you would expect that it would have gone up, doubled, etc. And it has, and I'm speaking MENA specific, but it is these factors around it's these numbers around capital raising, which I think point the direction and the way for the future. And when we look back on this crisis, and we've all already begun to look back on it, what are the lessons learned, and what do we, the regulated markets and those that regulate us, want to think about? We want to think about, it was a very existential conversation, you have to keep the market open. If you don't keep the market open, if you don't keep the exchange open, nothing really can happen in capital markets through the crisis. So that's one, I think this was a phenomena of this crisis that people began to talk about closing the exchange and shortening trading hours, whereas in the last crisis they didn't. So I think that's a very existential point. I mean, IOSCO came out with a strong statement as well, in favor of saying you must keep your exchange, you must keep your markets open. So that's a very fundamental point. And then the other, going back to some of Fianna's comments, is that as we, issuers, companies listed on markets, already face, quite a high burden. So the constant conversation we have as exchange industry or as regulators is, why should companies list on a market when the private funding options are available, there's less transparency, etc. So I think from a regulatory perspective, there needs to be a narrowing of that divide. I mean, there needs to be more support for exchanges and for companies to list on exchanges, because that gives you the virtue of greater transparency and some of all the other good stuff that comes, through listing. And the capital raising the numbers that I've talked about are really the icing on the cake if you're a regulator. I think there needs to be a strong regulatory response that supports issuers, in raising that capital in regulated markets, as a way, kind of, as almost like as a DNA kind of thinking.
If I may, Jalil,
yes, please.
Quickly jump in. I think also the looking at risk and long-term risk, and how you measure that risk, how companies are looking at that risk, and how they're making their long-term planning will be really, really important. And then also a little bit based on what Nandina just said as well, it's really important, I think, on the one hand, while regulators are showing adaptability and flexibility to issuers, which is critical in this crisis phase, it is also important to find the right balance to reassure the market and investors that the standards of quality are there. You see, so it's a fine line to find that balance. I understand that more difficult to do in practice than to give the advice, but very important to show that while there's adapting, while there needs to be flexibility portion, this has to be very, very much based on quality, audited, financial statements. And I think, that was one of the things I didn't mention. It's in the report, of course. And I know that audits now are very tricky considering that people have been in lockdown. But I think it'll be very important to make sure to reassure the markets that the information is verified and according to high quality. Yeah.
Thank you so much. We are very close to the end of this webinar. I just want to give every distinguished speaker for closing remarks. Start with Stephen, please. Stephen.
Thank you, Jalil. Well, my remarks are really, I think this event has been very worthwhile. I think it's been very good to hear the perspective of OECD, WFE in today's event. We remain optimistic. I mean, what we're seeing here is, as you've heard from my colleagues, sentiment is coming back, in the short term. There is cautious optimism for the longer term. Yes, there will be very difficult economic conditions to navigate, no doubt, on a regional basis and globally as well. But I think, as I was saying before, the individual preferences to express people's identities through our investments is a very clear theme. And I think, industry is different this time. Stakeholders are different. And from what I've seen so far, most are assuming their responsibility to play a constructive role in the recovery. So I think it'd be very interesting to have a repeat of this seminar in, say, 1 year's time when we can reflect sort of 1 year into that recovery process. But for now, we remain certainly cautiously optimistic and look forward to continuing the dialogue with you and your members going forward.
Thank you, Stephen. Nandini, please.
Thank you. And if I could echo Stephen's remarks, I would also like for all of us to be optimistic. We have to focus in a world where we are focused on the many difficult things that we are undergoing now. Let's look, first of all, at what has been right? Markets have been resilient, exchanges have been resilient, the structures that support the capital market have performed strongly through the crisis. They have not triggered another crisis. That's a lot to celebrate. Right? We can never avoid, we can never live in a crisis-free world, but all we can do is ensure that the structures that we use to manage those crises are robust. And we know now that, with hard work, etc., that is the case. The second is that those capital raising numbers I pointed to, they point to where the future will be. Growth will return. If companies are finding a way to raise capital, they are beginning to use capital markets for that, there is hope. And we should be optimistic, because at the end of the day, for a regulator and for a regulated market and for organizations like the OECD and like BlackRock, if you can have transparency and price formation through a crisis, we can weather whatever comes ahead. So we should all be optimistic.
Thank you so much. Fiona?
Thank you. Well, I love the optimistic, you know me, Jalil. I like this optimistic and very action-oriented conversation. And I totally agree with both speakers. I just want to say a couple of things. One key message is this is a global pandemic. Just to remember, MENA is not alone. And so we are here really to offer our support as the OECD and to make sure that you get the best analysis around the world, looking not just at the quick fixes that have been going on, but really thinking long-term. And we will be devoting a lot of resources to this reflection and this analysis, which I think we need time for. And so we rely on your constant sort of feedback to make sure that we are working on the right issues for you. And I look forward to continuing to work together in the OECD MENA corporate governance group to address some of these critical issues in the future.
Thank you, Fiona. I'm happy to let you know that Mr. Paul Andrews is now with us. Mr. Paul, do you hear me?
I do hear you. I do hear you very well. And my sincere apologies. I just made a mistake with my agenda today, so I'm terribly sorry.
We are very happy to have you.
I was able to hear the last set of speakers and very, very interesting remarks.
I think being late, we'll give you less than 4 minutes.
Well, thank you. No, and I appreciate the opportunity. It's I know we're at the end of the webinar.
I just want to ask you a question to start with.
Sure. Of course.
With this pandemic, I believe that many of the institutions has already trying to change their priorities. And I'm sure IOSCO is one of the international institutions that they already in the process or already changed their priorities in a way or another. Can you please just brief us on how the pandemic will affect regulators, especially IOSCO?
Thank you. No, very, very happy to do that. I mean, and you're absolutely right that the pandemic has changed the way we're looking at issues in today's world. And I think one of the things we've tried to do over the course of the last couple of years is be very clear and open and transparent about what we're going to spend our time on. And we've issued in January of the last 2 years what our public work plan is going to be for last year and for this year. But of course, with the pandemic, we've had to change or make some changes to that. And essentially, what we did is we came up with some principles that we follow when it comes to what work we're going to focus on. And primarily, the focus has to be, and we thought clearly was the center of, what can we do to try to alleviate some strains and pressure both on the regulatory community, but also on the industry when it comes to addressing the core issues with respect to COVID-19. So for us, that was all about issues around liquidity, dealing with issues around asset management and how we could continue that work, because those were issues of today. So liquidity was an issue we continued to work on. Margin was an issue we continued to work on. But the other things that we had planned to do for this year, we may get back to them, things around crypto assets or things around index investing. Those kinds of things we may get back to depending upon how the pandemic ultimately pans out. But at the outset, we thought it was more important that we all focus on COVID-19 and address the issues that we all needed to do that. And as Nandini said earlier, one of the things that we did was be very forceful about the notion that markets should remain open during this difficult time. And I think in hindsight, that was a good policy that most everybody in the world followed, because it did help alleviate a lot of pressure and make people, I think, relax a little bit that we weren't blocking the fire exits during the fire. So there's much to be done, of course, and our hope is that we'll get back to a normal routine soon. But I, like the other speakers, share the optimism that we can do a lot, and we can do a lot together. And webinars like this, I think, really help, because they give us an opportunity to talk to one another and learn from one another as well. So thank you, and again, I'm sorry for my tardy arrival.
Thank you so much, Paul, for your intervention. And I share with all of you our optimistic. I think the market has reacted rationally, I believe. And it is really very, very important that we should keep the market working. And this is very, very, very crucial. Unfortunately, as Nandini mentioned, some of markets has halted for sometimes long period, but at least we should now be clear that we should keep the market doing its functions, doing its role in discovering the prices and in helping the economy. And this is really very crucial. And I think if we look to the performance of the market in the last 3 to 4 months compared with the beginning of the year, I think despite this huge impact on the economy, I think the measures taken by capital market authorities, the central banks, and other international institutions, giving some guidelines on the how to deal with the pandemic, for sure help the market to recover. And I think if we look to major indices worldwide, I believe many of them and major indices already have overcome the impact of the pandemic. At the same time, we still need to be cautious. We still need to make sure that we are doing our proper reaction to the changes, to the development, and to the benefit of our market. And finally, I think what we all aim is to make sure that investors in the market are protected and provided with the proper information and the timely information that they should receive, especially with the impact of the pandemic recently, the previous, and also what we should expect in the future, especially in the stand of the position of the company. I think we are closing this webinar. At the end, I would like to thank our distinguished speakers from all over the world, from the international institutions. I'm very proud and happy to have all of you. And this is really, this webinar is really encouraging us to have more and more interaction and have more and more focus on our region. We are really anxious to have you in our future webinars and events very soon. After that, I will just close this webinar. Thank you so much.
Thank you.
Thank you.
Thank you.
Thank you.